Welcome to the latest edition of our Fixed Interest podcast series. I'm Paul Gamble, Head of Middle East Africa Sovereign Ratings at Fitch. And today I'm joined by Thomas Garreau, Associate Director in the Middle East Africa Sovereign team and Lead Analyst for a number of sovereigns that have requested a common framework external debt restructuring, including Ghana and Zambia. In this podcast, we'll be discussing the key takeaways from recent common framework developments and the outlook for this process. So Thomas, it seems that we are moving forward with the common framework restructurings. Could you describe where we stand?
Thanks, Paul. Indeed, there have been some very recent developments. So maybe as an introduction, let me recall which countries have requested a common framework restructuring and what the common framework is. So the common framework was drafted in November 2020, a few months after the debt service suspension initiative, to address the liquidity and solvency issues that arise in the context of the COVID crisis. So far, 4 countries have applied for the common framework: Chad, which we do not rate, Ethiopia, Zambia, and Ghana. It's important to emphasize that only least developed countries and low-income countries can request an external debt restructuring under the common framework. This is why other sovereigns that are currently restructuring their external debt, like Argentina, Lebanon, Sri Lanka, or Suriname, are not using the common framework.
Thanks, Thomas. As we currently don't rate Chad, which completed its common framework restructuring in November of 2022, let's start with Ethiopia. So where does it stand?
Ethiopia requested a common framework restructuring in February 2021. Like any common framework restructuring, the very first step, is to reach a staff-level agreement with the IMF for a program that will accompany the restructuring and that will aim to put public debt back to a sustainable path. Negotiations between the IMF and Ethiopia had been suspended because of the war in Tigray. They resumed in November 2022 after a peace agreement was signed. Negotiations have been particularly long, with some resistance from the authorities to some of the prior actions that were required by the IMF, and in particular, the liberalization of foreign exchange markets. The SLA has eventually been reached in July 2024, and the IMF board approved the program a few weeks later. This followed a liberalization of the foreign exchange market, and in particular, an alignment of the official exchange rate with a parallel market exchange rate. Interestingly, the time for the IMF board approval has been relatively short compared with previous common framework treatments, thanks to the implementation for the first time of the new IMF policy on restructurings. We will discuss this new policy later. So now, the Official Credit Committee has to agree on the parameters of official debt treatment that we expect by the end of this year. Following this agreement, Ethiopia will discuss the parameters of its external commercial debt treatment, including its $1 billion Eurobond, with private creditors to reach an agreement on comparable terms. We downgraded Ethiopia to restricted default in December 2023, following a missed coupon payment on its Eurobond. Once Ethiopia completes its restructurings with private creditors, including on its non-bond commercial debt, we will move Ethiopia out of default.
Thanks, Thomas. What's the status for Zambia? It seems they are close to a full completion.
That's correct, indeed. The process has been very long for Zambia. Zambia requested a debt treatment almost 4 years ago in February 2021. Following its official debt restructuring, Zambia successfully exchanged its 3 Eurobonds in June 2024. This exchange entailed a significant debt relief and will contribute to a decline in debt to GDP from 128% in 2023 to 110% in 2024 and 99% in 2025 in our forecasts. Still, debt stock would remain above its pre-default level, but debt service is lowered. So following the Eurobond exchange, we assigned a CCC+ rating to the new bonds, and we affirmed Zambia's long-term foreign currency IDR to restricted default because Zambia still has to restructure its non-bond external commercial debt. That ends 2022, this still represented 28% of commercial credit claims. Once Zambia successfully exchanges this remaining non-performing debt, we will move Zambia out of default, and we expect Zambia will complete its common framework restructuring by early 2025.
Thanks, Thomas. What's Ghana's status?
Ghana requested a common framework restructuring in January 2023 and completed its official debt treatment in Jan 2024. In October 2024, Ghana concluded its Eurobond exchange. We assigned a CCC+ rating to the newly issued US dollar bonds. This Eurobond exchange entailed a reduction in debt stock of about 6% of GDP. And like Zambia, Ghana still has to restructure its non-bond commercial debt. This is why we have, after the Eurobond exchange, affirmed Ghana's long-term foreign currency IDR at RRG in October 2024. We expect Ghana will move out of default early 2025.
So what are the key takeaways from these recent developments?
The first takeaway is that the common framework has proven to be a slow process for external debt restructurings so far. This process is highly standardized, and we explained the various steps in the Fixed Interest podcast we published on the 14th of November 2023. The reasons why negotiations have lagged are to be found in the composition of creditor landscape, with the presence of some new creditors like China, which are less familiar in terms of participating to a restructuring process in a multilateral format. Delays to provide the financing assurances from official bilateral creditors have resulted in prolonged periods of no IMF disbursements. Also, the technicalities of an IMF supporting a restructuring were unclear to some stakeholders, both debtors and creditors. For instance, the amount of debt relief that is required by the IMF and that derives from both the cash debt relief over the IMF program period to fill the external financing gap and from the debt sustainability analysis thresholds that must be met to get public debt back to sustainability has been sometimes quite opaque and have proven to be a source of contention. Any agreement between the debtor and its private creditors that would not meet these IMF's requirements would necessarily be rejected. This is, for instance, what happened with Zambia and Ghana. In both cases, the agreement in principle with a steering committee representative of bondholders was rejected by the IMF, and a new agreement in principle had to be found. Another requirement is the comparability of treatment between official and private creditors. These two agreements in principle were also rejected by the official credit committee in the case of Zambia and in the case of Ghana, because they failed to meet this clause. Finally, some idiosyncratic factors also contribute to explain why negotiations have lagged, especially in Zambia. I mentioned the debt sustainability analysis thresholds. These thresholds depend on what is called the debt carrying capacity, and the debt carrying capacity of Zambia was assessed as weak by the IMF, but close to the medium threshold. And having a medium debt carrying capacity would have resulted in lower debt relief requirements by the IMF. This was addressed eventually with a value recovery instrument that will offer higher coupons and shorter maturities if Zambia reaches a medium debt carrying capacity during a specific window.
So what are the consequences of these delays?
Well, delays are problematic for both debtors and creditors and can contribute to deepening of debt distress, making adjustments even more difficult. In the case of Zambia, the kwacha has been very volatile against the US dollar throughout the restructuring process and has depreciated by 16% between February 2021, when Zambia requested a common framework treatment, and July 2024. So this depreciation, together with heavy reliance on expensive domestic financing in the context of prolonged delays in access to concessional international finance, have resulted in a debt stock that in percentage of GDP remains very high post-restructuring. We expect public debt to reach 99% of GDP in 2025 for Zambia and 92% in 2026. This ratio was 82% in 2019 prior to the default. In the case of Ghana, the cedi has depreciated by 36% between January 2023, when Ghana requested its treatment, and September 2024. This depreciation contributes to a foreign currency debt stock that we expect in our forecasts at 43% of GDP at end 2024, unchanged compared with 2020 and 2022, despite the significant efforts from creditors, including haircuts.
Okay, thank you. So, can we expect the delivery of debt restructurings to be more timely in the future?
Yeah, I think we can reasonably expect that this will be the case, mainly for two reasons: the learning curve and a revision in IMF policies. So again, an external debt restructuring in a multilateral format was a completely new process for some creditors, and especially for non-Paris Club official creditors and for some debtors. Now that the methodology is well understood by everyone, we can expect future restructurings under the common framework to deliver in a much timely manner. And this is already what we can observe when comparing Zambia, which was a very long process, with Ghana and Ethiopia, although Ethiopia is still at the very early stages of its restructuring. Also, in April 2024, the IMF revised some of its policies to promote the fund's capacity to support countries undertaking debt restructurings. 5 policies have been revised, but I will focus on 2 of them: the lending into official arrears policy and the financing assurances policy, that, to me, will contribute to accelerate debt treatment processes. So first, the new lending into official arrears policy. The starting point is that the IMF has a non-toleration of arrears to official creditors. And for a number of countries that applied for a common framework treatment, they had accumulated such arrears. Still, the IMF can provide support to these countries with what is called its lending into official arrears policy. Prior to the recent revision of this policy, there were 3 cases in which the IMF would agree to provide support. Either an adequately representative forum of official creditors has been set up, like an official credit committee with Paris Club involvement, but in this case, the IMF needs to wait for this forum to provide the financing assurances, and we will see that this can take some time. The second case is there is explicit consent from official creditors to whom the debtor has accumulated arrears. And the third case is a combination of 3 criteria that are strict, and I will not enter into too much detail here. So the new modality for the IMF to provide support to a country that has accumulated official arrears is non-objection. In case the modalities we just mentioned are not met, the IMF would allow a certain period of time for official creditors to provide consent, and the IMF explicitly mentions a 4-week window, although it also says it could wait longer if deemed useful. And after these 4 weeks, if there is neither explicit consent nor explicit opposition to IMF support, then the IMF would consider it can provide such support. This sounds like a minor revision, but in recent restructurings, prolonged negotiations among creditors to approve IMF support in the presence of official arrears have held up programs because of creditor coordination issues or because of bureaucratic fragmentation within one creditor. The second revision relates to the financing assurances policy. Provision of financing assurances from official creditors is necessary for the IMF board to approve the program. That's the very first step of a common framework treatment, or let's say the second step after the official creditor committee is set up. Concretely, provision of financing assurances means 3 things. First, a firm commitment to fill any financing gap during the first 12 months of the program. Second, good prospects that there will be adequate financing over the rest of the IMF program period. And third, a commitment to enter into restructuring negotiations that are consistent with the IMF program parameters. For Paris Club members that have robust internal procedures for timely provision of financing assurances, this has not been a source of delay. But for new official creditors that are not members of the Paris Club, internal processes can prove to be very long, including because of legal frameworks that do take time to be modified. In the case of Ghana, Suriname, and Sri Lanka, for instance, the financing assurances requirement proved to be a source of significant delay for timely support, with China failing to provide these specific and credible assurances for a prolonged period of time. With the revised policy, the IMF will no longer necessarily wait for these explicit financing assurances, but it will assess the internal procedures that are in place in a creditor. So concretely, the IMF will assess whether a key stage of decision-making has been passed within the creditor's internal procedures. For instance, whether a person with the authority to commit the creditor has agreed with the IMF program parameters and with the required debt relief without waiting for the explicit financing assurances to be delivered by this creditor. If we take again the example of China, the financing assurances needed to be delivered by the State Council, which for internal procedures can obviously take some time. So this is what the IMF calls a credible official creditor process. If the IMF board, advised by the staff, is confident that this credible official creditor process is in place, it can approve the program. This new policy has been implemented for the first time in the case of Ethiopia, and this explains why the IMF board has been able to swiftly approve the ECF, the IMF program for Ethiopia.
Thank you very much for your insights, Thomas, and thank you to everyone for listening. For more information on our ratings and our research on sub-Saharan African sovereigns, please visit us at fitchratings.com. We hope you will join us for this next edition of Fixed Interests.